Stocks continue to trade really lightly coming after Nvidia's earnings and the really significant gap to the upside last Thursday. We haven't had a whole lot of follow through. We've been pretty much trading inside of that day's range the past few days. A little bit of a move higher on Friday than that today and yesterday, trading inside of that range. So not much follow through. Not breaking down into that gap either, but not much follow through left on the S&P 500. What could that be telling us, and what are some of the charts looking like today now with another day buy? So we're going to take a look at those charts and see the likelihood that we can maintain and maybe even get a little short-term buy the dip pattern here going on. We'll take a look at some of those past instances if that's happening on this particular intermediate run. We'll take a look at what's driving today's action, not what you would expect. Some interesting sectors leading the way higher today, interesting sides of the market leading higher, especially considering that three-headed monster I always tell you about reared its head today to a small degree. Nothing major, but to a small degree it reared its head. And so I'll show you that and its impact on these different asset classes. Then our trade idea is a stock that gapped down rather significantly today. So we'll talk about how to trade that with somewhat limited downside that it might have after this gap. We'll talk about how to trade it going forward. So let's go ahead and get started. Today is Tuesday, February the 27th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I review all the old trades we've done in prior Market Outlook videos to see if we should stay in them or not. And we also put on today's trade already before the market closed during that particular video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on that platform, on those platforms. As always, our goal is to get to 100 likes on Twitter. So thank you to those who do like this day in and day out, and those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicators. You can see the intermediate line here is continuing higher. Now is back above the 90th percentile. Remember, it's pretty rare for it to be there at all, much less as extended as it was over here at the end of last year. And then again, now, three different instances here of getting back above, well, really four if you count that one, this calendar year so far. So continuing to really push to the upside here. The market sentiment line's falling, but again, it's above the 80th percentile, so it doesn't really matter which way it's necessarily going. And the thing that matters, the most is the intermediate line is actually above the market sentiment line. That's what matters. The near-term line has dipped, so it did not stay in bullish territory for very long. It did not finish in bearish territory either, as we avoided that with this little rally we had at the end of the day, thanks to Apple. And then, of course, the momentum line also was actually in the oversold levels for a second straight day, but then it came out, again, thanks to the rally we had, the intraday rally, which, again, we are 2.75% above, down there above the 30-day moving average, despite this near-term pullback that we're getting, which it happens to be just a couple of days. So it's not the best intermediate confirmation signal, but it's about the same as what your typical intermediate confirmation signal will look like, which is kind of a buy the dip signal. Your intermediate line also crossed back above market sentiment on the NASDAQ 100, easily above 2% above the 30-day moving average. Your near-term line is below the chart's midpoint. Again, not staying for very long in bullish territory. And your near momentum line, bounced back up out of oversold territory, looks almost exactly the same as the S&P 500. If you look at other charts like the Dow Jones Industrial Average, you can see its intermediate line has crossed up above the market sentiment level. Its momentum line has jumped up too, but its near-term line did dip. So we had a little bit more of a bearish decline on the Dow. Again, less sensitive to the Magnificent Seven stocks as now we had a third in there. But But pretty much looks similar. Again, the intermediate line rising above a falling market sentiment line up in the upper reversal zone. They're also had the best day today out of all the indexes, really gapping up pretty sharply here. All three lines, intermediate, near-term momentum line, all rising. The near-term line rising again, back up above the 90th percentile. The momentum line, it's looking almost exactly like we saw over here, where we moved up so far so fast. The momentum line wasn't able to get there when the near-term line did. It's kind of like what we just saw these last couple of days. It's actually been, 4 days in a row now of increases. And it's brought the intermediate line above the market sentiment. Now, granted, that is below the 80th percentile, and the intermediate line still hasn't crossed the 80th percentile on this rally. We do have dark pink shading and green line again, so we're back to a bullish stance. And the near-term line is up in the upper reversal zone. So now we kind of need to stay there long enough that the intermediate line can get there too, and we haven't had that. Right, it didn't happen here, and it didn't happen here either. So we'll see if this takes, right? If we can stay there long enough, you probably will get that intermediate line above 80. If not tomorrow, as long as we don't fill in this gap. If not tomorrow, then probably Thursday. We'll get that intermediate line up into the upper reversal zone. Kind of looking at some of the other major assets out here. So the dollar index continues to decline. It's down to its 30-day moving average. You got light pink shading. The intermediate line is falling below the 80th percentile. That's what produces the light pink shading. But you notice it still hasn't dropped out of bullish territory yet. Your near-term line still hasn't crossed above it yet. So that's why we're not getting our bullish bounce here. Your near-term line is still kind of in below bullish territory. Still trying to figure out this bounce, whether they're actually going to get a near-term bounce. On the other hand, the intermediate line, despite its decline, is still above its rising market sentiment. So we're still bullish despite this near-term decline on the dollar until, of course, something changes there. The TNX looks very similar to stock market. The market forecast is strongly bullish above the intermediate line, above the 90th percentile for a good chunk of these indexes. The near-term line and momentum line bouncing up, so we got a little buy the dip going there. So we're about up to 4.31% today. Back in the bullish territory on both those short-term sentiment lines. Then, of course, commodities, which have been so bearish. Short-term sentiment, the near-term line has stayed above the intermediate line there. The intermediate line has turned back up. It's in bearish territory, so we're not out of the woods here. But you can see there's some kind of base forming. Remember, the biggest component of commodities is crude oil. And crude oil's intermediate line is strongly bullish, right? It is, we got dark pink shading or dark green shading in the green line. Your intermediate line is above the market sentiment, and it is in bullish territory above the 80th percentile, and both short-term sentiment lines bouncing off of a pretty much a bullish near-term bounce there. All right, let's take a look now at the long-term chart here. So you can see the higher closes we're getting, and it's slightly lower high point. So we're still maintaining a bullish posture, 7.25%, very, very strong PPO. Not quite the 90th percentile yet, but pretty darn close. But the higher close is what really matters. The problem is, again, still, the green line is slightly below the purple line down here, but you see the convergence that we're getting as we're coming down these peaks, and not really strongly bullish. When you look at the three green arrows, we are back to three green arrows on the Russell 2000 now. That was one that we hadn't gotten. The Qs still don't have it yet. The MACD is still negative. The S&P, the diamonds, still have three green arrows themselves, though their MACD is not really gaining any momentum and looking like it's actually going to turn slightly lower here. If you look at the S&P on this chart, you can see that the PPO is above the MACD is above its moving average down there. The stochastics is also above its moving average, and you can see we are up there, up above the 8-day, still above the 17-day. You can see when you're bullish, you're going to ride that 8-day that entire time, and little pullbacks might come below the 17, but if you get right back up above them like we have been, we'll just stay above it the entire time. Breaking the 30 is when you really start to get concerned about filling in the gap to the 50 and then beyond to the 200. And And obviously, we're not anywhere near that. We were threatening that on the diamonds, or excuse me, IWM. But again, you see how strongly bullish we are now, flirting with a new 52-week high with that gap that we formed here this morning. So you look at some of these oscillators. We are now below 40. Despite a little bit of a rally we got today, we are below 40 on the DMI. Remember, we don't stay above 40 for very long, and when you are above 40 and you drop, it tends to precede at least convergence, if not the beginnings of consolidation there on SPY. IWM, on the other hand, has broken back out. Again, its negative indicator still not below 20, and that's the same thing with the spiders. It is so rare for the positive indicator to be above 40 and the negative indicator to not be at least below 20. Remember, there was a time here that the negative indicator was above 25 and the positive was even higher. That was unbelievably rare. But this is a pretty rare combination too, that we're still pretty bearish from the negative indicators perspective, while being strongly bullish from the positive indicators perspective. If you look at IWM, again, the breakout pattern, but your negative indicator is not above 25, but it is still above 20, so we still don't have that breakout yet that can help that ADX really get going, like basically get into a trending move after this, again, uncommon parabolic move that we had at the end of last year. Just to kind of give you some perspective, this, in the last 5 years, this was the biggest bullish move that we've seen on the Russell 2000. And we've had other parabolic moves. The reopening trade was a pretty decent parabolic move, but even its ADX, and for that matter, the positive indicator, didn't get as bullish as it got right now. Or excuse me, late last year going into now. So we did continue the bullishness there, but you see after that parabolic run, it was hard to really extend away as we went into this almost year-long sideways move which is really good for options inventory trading for the Russell. We had a really good year that year in the Russell 2000. Not good if you're got a long exposure, an overweight exposure to small caps in your long-term portfolio. If we take a look at like the RSI and the CCI, you can see still at bullish levels, so that's really good. Looking at the Ichimoku cloud, you can see we still have a continuing bullish move. We're up to 18.5 now. The trend noise balance is still a very, very strong level, so still very mature rally. IWM, remember, had ended its run and still doesn't even have the beginning of a weak bullish trend. Now it looks like we might be starting that. It's got to get above 1 and it's got to get above 50 here to just be a weak bullish trend. You are above the cloud, the green line's above the blue line, we have a positive rate of change. So all of that's positive except for the fact that we just haven't started that trend yet. And then from a Bollinger Band perspective, we remain in the upper quartile of the bandwidth. The bandwidth is still relatively large and outside the Keltner channels, and you see the momentum is maintaining its bullish position. IWM is back into its upper quartile of the bandwidth. Renewed bullish momentum, but still the Keltner channels are inside. The Bollinger Bands are inside the Keltner channels. And again, that may not last too long if we continue with the bullish momentum to the upside. If you look at the intraday range, you can see that gap that's still there on the S&P. Again, break above 510 and we can kind of get away from it. But we're still kind of hanging around it, threatening to fill it in. IWM, remember, did fill in this gap, but now has another common gap to fill in potentially, and still hasn't formed a new high point. So its positive indicator is below 70, and it's working its way down potentially to below 50, barring a new high point that we may get here tomorrow morning, right? If we can continue the bullish momentum, this 4-day bullish win streak there. Finally, let's take a look at the VIX. The VIX is down, but not below. It continues lower, 2% lower, but did not get below its 90th percentile. The VVIX, remember, is back below 80. That's an extremely low level. It tends to bounce from these extreme low levels, which again, all the VIX, every time it's been bouncing off of higher and higher lows, and as of right now, we're sitting right at the 50-day average value of the VIX. Which has been gradually increasing, and we'll see how much longer we stay below some of these other moving averages on the VIX and stay down. Again, there's not much downside to the VIX when it is already as extremely low as it is, and especially when it's not getting on a relative basis down further where it probably should be compared to the last time we were right around 13.5 or lower. We were well below 90%, flirting with the lower half of this kind of bearish territory for volatility. All right, let's take a look now at what's driving a lot of this price action. Again, you can see how U.S. equities just continue to dominate over the past few months, 3-month time frame. Let's look at just today alone, and IWM was your biggest winner today, despite, again, an increase in yields, an increase in the dollar, and an increase in commodities. Those are the three things that generally don't help equities out. And of course, you can see for a time there, the S&P and the Qs were negative until, again, Apple's big intraday move higher that brought the Qs higher. But even then, they were much lower compared to the strong rally we had in IWM. Again, if you were to go all the way back to when we peaked here, let's go back to, let's actually go back to October the 27th. So the last time we actually bottomed up until now, the rally. Again, you can see the Qs, well, here, let's change this to something a little bit longer term. The Qs really started to take off, and the IWM kind of caught up. Qs took off again, and now IWM is catching up again. So again, this is off of the low point with weakness in commodities, weakness in the dollar, weakness in yield, strength in bonds that helped propel what is now a 27% return and now a 24% return from IWM. That's probably really the biggest reason for IWM's gain today, as it just continues to catch up to where the rest of the U.S. market is, up above the 20% mark here. Emerging markets continue to lag behind, with China and developed markets as well lagging behind, but they're still up strong against global bonds, which are down here at the bottom, and U.S. bonds, which are doing well. And treasuries, interestingly enough, are outpacing long-term treasuries, are still outpacing high yield, except when you look at high yield relative to a similar time frame, duration time frame in the treasury complex, so that would be IEI, you can see there's actually not a whole lot of weakness there. Continues to be pretty strong, well above these moving averages, very strong correlation to the S&P 500, very bullish, right? And you can see even the long-term chart here, if I were to zoom out a little bit, you can see just how bullish that spread is. It's pretty close to its strongest it's been since 2021, and of course coming off of the lows there of 2016 into early 2017. Very, very strong spreads. And that's where we're at right now. And even the PPO itself is, the intermediate term is very strong, and the RSI is up there. So there continues to be some strong correlations here. The one thing that did not do as well today was how the Qs performed relative to IWM. So it was obviously down with IWM taking off today, and it's below its moving average. You can see the 8-day there is also below the 17-day. The PPO is negative down here. The histogram of the long-term PPO is also negative. CCI coming down from a bearish peak. You almost got a crossover there on the DMI, and the RSI coming back below 50. So remember, it's okay. A move down towards the 200-day moving average is okay. You can still be bullish in the stock market, as we saw to a degree today. Breaking the 200-day moving average, with the strengthening correlation back to where it normally resides on the long-term basis. A break below that 200 with a positive correlation with the S&P would reflect the lack of leadership from the market leadership, these big market cap stocks in a market cap weighted index. Of course, the breadth today, if we take a look at the breadth, the new highs and new lows remain relatively strong, above the moving average, above 300. If you look at how many stocks are above the 50-day moving average, we're sitting right at the moving average. We did climb above it last week. We dropped back down below it yesterday. We're still kind of sitting right at it. Same thing with the 200. We're actually a little bit above it still. And that's kept the ratio, this important ratio here, slightly below its moving average. It did not produce a swell in the skew. The skew remains pretty subdued, well below its moving average itself. Again, that generally leads to some softness in the markets. So we'll see if that ends up being the case again here. Again, last time it led to at least a convergence move. It did not consolidate before we bounced back up in the skew, but just keep in mind too that the average of the skew here at 150 is already at a pretty high level. Very, very high level. Again, the last time we dropped back below 150 was during this intermediate decline that eventually led to a divergent high point and then the ultimate correction. So needless to say, this is a pretty high level for the 20-day average of the skew that generally doesn't spend a whole lot of time there. The other thing we look at from a breadth perspective is that McClellan oscillator and the money flow. The McClellan oscillator is still at very, very low positive levels, so we don't really, it's kind of hard. We had a trending oscillator going there, but now we've kind of run out of gas. That's okay. You can see when we were bullish over here in 2021, we didn't have strong breadth either. But you also see what happened when it ran out of gas. And you can see from a money flow standpoint, let's see, it's going to be right here. The oscillator itself is it's below 60, but it's almost below 50. Again, that's typical. Crossing below 50 would be a bearish sign from a money flow standpoint. That's kind of like when things turned bearish over here at the start of this intermediate decline. You can see some other instances of that over the last few years. Breaking below 50 usually kind of started the weakness, if not, started the intermediate decline in all these instances. So really important that we stay above 50 and maintain the bullishness, especially considering how strong this run has been. Looking at the hull, which is also something we've been watching here pretty closely, you can see that again, we are still above the 20-day hull. We only had a brief red hull there. The last few times that we've had the hull red, it's been very brief. And we've been converging towards that 200-day hull for the good chunk of this period of time without an extended declines, right? The parabolic SARs are up there. You can see the parabolic SARs continue to be very close to where we're trading on the weekly chart. And the PPO on the weekly chart up at the 98th percentile, just off of its high. Not below its average yet, but something to keep an eye on as we near the potential for a convergence period to start there, with the Heikin-Yashi differential trading around, as we showed on the other chart, around its declining moving average. Let's take a look at how the sectors are moving. So bear with me 1 second while I bring in the sector comparison chart, and you can see over the past 3 months, it's been, pretty broad. Financials, industrials, healthcare, all doing pretty well. Technology, communication services, discretionary, all up there too. And if I just look again at just today alone, today it was all utilities, which is interesting. With the rise in yields, utilities were the biggest mover by far to the upside. XLC was a pretty decent mover despite the weakness in Google here lately. XLC rebounded after yesterday's decline. XLK is kind of lagging the market. In fact, XLK at one point in time was the weakest performer. Healthcare and energy ended up being the weakest by the end of the day. And you can see when you look at the 12 grid. Remember, XLK, XLC, XLY are all pretty strongly bullish. Pretty much everything now is dark green shading a green line except for utilities, but utilities rally today helped at least solidify this bull tag, bear tag, that it got down here, and then the real estate, you can see kind of what it's doing. If I look at the Magnificent Seven and how they're doing today, some of these did pretty well. Microsoft was flat. Apple did pretty well, but keep in mind Apple's been relatively bearish. Nvidia, Amazon, Meta, and Broadcom all weakening on that after recent AI strength. Meta is still holding its gains. Google, however, Adobe, Cisco all still holding its declines. And Tesla got this bull tag yesterday. Hasn't really followed through with it yet, and we'll see if it ends up following through by the time all is said and done. But you can see we are not dark green shading and a green line across the board here. In fact, there's a lot of dark pink shading and a red. In fact, four of the 12 charts are dark pink shading and a red line, kind of showing some cracks in the strength of this bull market that we're in right now. Right now, our trade idea of the day, is on Amgen. You can see it's in a pretty bearish intermediate decline right now. It's at its lowest level below the moving average here, about 7%. So pretty decent decline to the downside. Dark pink shading and red line. Market sentiment's falling. We are below. We are below the intermediate lines in the lower reversal zone, well below market sentiment. Near-term line coming off of a bearish peak. You can see when you look at the weekly candles, Hakinyashi candles are pretty strongly bearish. Pretty strong bearish candle there. We got the red arrows. You can't see it. It's up, hidden by that tag up there. But you can see how we still actually pretty strong gap between the 50 and 10-week and 40-week moving averages, and you're still relatively bearish from that perspective. Obviously, you have 3 red arrows. We are below the 8-day moving average after hitting it for resistance, breaking back down today, gapping down with some pretty average volume. The 8 and 17-day well below their 30-day moving average, moving towards the value area, and a pretty strong volume node right around the 200-day moving average. So not a whole lot of downside potential to the stock. If you look at the DMI, it's pretty bearish. You're above 30 on the negative indicator, below 20 on the positive. Your ADX is already pretty strong, so you're already susceptible to some significant moves. If you look at the Ichimoku cloud, you can see we have a intermediate trend strength. We are below the cloud now. That was the significant gap, kind of a breakaway gap from that perspective, since you're breaking down below that cloud there. RSI and CCI both at bearish levels. The weekly CCI is back below 0 and working its way towards the minus 100 level, which would start a long-term bearish decline. And then, of course, your Bollinger Bandwidth. We are not in the lowest quartile, though you are flirting with it. The band's very strong. The bandwidth, you can see, is up above the 20% mark. Strong momentum to the downside. We are below the Keltner channel, so pretty strong move. But again, already had a bulk of its strength, so I don't want to necessarily do a strong directional trade. And what we're going to do instead is we're going to sell a bear call spread at the 30 deltas for March. And you see we actually get pretty decent credit still for March. And that break-even point, if you notice, ends up being at today's gap. So as long as we hold today's gap to the downside, then we're fine, right? We can actually make this trade and continue to extend lower. If we were to move back up into that gap, then then we're going to be willing, again, we're willing to lose $443 on this, and so that's about where you would have to really kind of completely reverse this gap and then some for us to be able to take that loss. So and we would in that case, and probably would be pretty bullish if we were to break above this 290 level. In which case we'd be looking at potentially a more of a bullish trade. But as of right now, it appears the technicals are appearing with limited downside to where we have to go. But again, we don't need it to go down a lot. We just need it to stay down. It can even go up from here, and I can still make it as long as it only goes up a little bit and stays below these moving averages, right? As long as it stays below like the 8 and 17-day moving averages, then the 8-day right now especially, then we should be able to make what we were looking to make on this. And if it did go down to the 200-day, the quicker the better, then we can be able to make a pretty decent return over the next few weeks. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping on the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.